There is a ghost in the machine of modern finance. It is a silent predator that has claimed more fortunes, dismantled more empires, and shattered more dreams of financial freedom than any market crash, recession, or technological disruption in history. It doesn't appear on the nightly news, and it isn't discussed in the breathless commentary about stock market fluctuations. It lives quietly, hidden in plain sight on a single line item within a company's financial statements, waiting for the slightest tremor, the smallest misstep, to unleash its full, devastating power. This ghost has a name. It is called leverage. Debt. And for the single greatest investor of all time, Warren Buffett, it is the one unforgivable sin, the one red flag that makes any stock, no matter how promising its story, completely and utterly uninvestable. What you are about to learn is not a complex formula or a secret Wall Street algorithm. It is the application of a profound, almost primal wisdom. It is the understanding that in the business of long-term wealth creation, the person who wins is not the one who makes the most, but the one who can't be forced out of the game. Debt is the one thing that can force anyone, from the corner store owner to the global conglomerate, out of the game. By the end of our journey together, you will possess a mental tool so powerful, so simple, that it will act as an impenetrable shield for your capital. You will learn to spot this ghost before it has a chance to haunt your portfolio, and in doing so, you will sidestep the single greatest cause of permanent financial loss. This is not a lesson in accounting, it is a lesson in survival. Our first step is to understand the true nature of this beast. We must go beyond the abstract and witness its destructive power firsthand to see how it operates not on a spreadsheet but in the real world of steel, sweat, and shareholder tears. We must understand the foundation of ruin and how debt possesses the terrifying alchemical power to turn perfectly solvable everyday business problems into existential, company-killing threats. To do this, we need to travel back in time, not to a slick Wall Street trading floor, but to the gritty, unglamorous world of New England manufacturing in the 1960s. This is where a young Warren Buffett learned one of his most painful and formative lessons. Long before Berkshire Hathaway became a global behemoth, it was a struggling textile manufacturer. In 1967, Berkshire acquired another textile company called Wambeck Mills, located in Manchester, New Hampshire. On paper, the deal looked reasonable. Wambeck had modern equipment, a decent product line, and the acquisition expanded Berkshire's footprint. But it had a fatal flaw, a flaw that would teach Buffett a lesson he would never forget. The entire textile industry was built on a razor's edge. Imagine the scene. A sprawling brick mill, hundreds of looms clattering in a deafening rhythm, churning out endless yards of fabric. The air is thick with cotton dust and the smell of machine oil. This operation is a symphony of immense fixed costs. The building itself, the heavy machinery, the unionized labor force, all of these demanded cash every single day, whether the mill sold a single yard of fabric or a million. This operational leverage was intense, but it was a known factor in the industry. Wambeck, however, added another layer of leverage on top of it: financial leverage. Debt. The company was financed with borrowed money, which meant that alongside the payroll and the utility bills, there was another hungry mouth to feed: the bank, demanding its interest payment, on time, in full, with no excuses. For a while things worked, but the textile industry was facing a relentless assault from cheaper foreign competition. Prices were constantly under pressure. A normal, debt-free business in this situation has options. It can cut prices temporarily to keep market share, it can slow down production, it can invest in efficiency to lower its cost base over time. It has breathing room. It has a margin for error. Wambeck had none. When a downturn in the textile cycle hit, as it inevitably did, the pressure became immense. The sales revenue, the lifeblood of the company, began to shrink. But the costs did not. The looms still needed to be maintained. The workers still needed to be paid. And crucially, the bank still demanded its interest payment. The interest expense is the most brutal of all costs because it is utterly indifferent. It does not care about your industry's struggles. It does not care that your biggest customer just went bankrupt. It cares only about the calendar date. Buffett, in his letters to shareholders, described the agonizing reality. He and his partner, Ken Chase, would fight tooth and nail, wrestling with costs, trying to find new customers, attempting to innovate in a commodity business. They were trying to solve a business problem. But they weren't just fighting the market. They were fighting the math. The debt acted as a massive amplifier for every single problem. A small dip in fabric prices became a catastrophic loss on the income statement. A temporary shutdown for retooling wasn't just an operational delay. It was a period where cash was pouring out the door to service debt with no revenue coming in, pushing them closer to the brink of insolvency. The end came in 1975. After years of struggle, of pouring good money after bad, Buffett had to shut Wombeck down. The machinery was sold for pennies on the dollar. Hundreds of workers lost their jobs. For Buffett, it was a profound failure. He hadn't just lost money, he had witnessed the anatomy of a corporate death spiral. The business itself had problems, yes, but they were manageable problems. It was the debt that made them fatal. It was the leverage that took away all their options, that painted them into a corner until the only move left was to fold. He learned that when a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. But he also learned something deeper. When you add debt to that equation, you don't just get bad economics, you get a ticking time bomb. The Wombeck experience was seared into his DNA. It was a first-hand education in how leverage removes a company's ability to play for time. And in business, as in life, time is often the one thing you need to solve any problem. This visceral experience reveals a deep psychological truth about why so many intelligent people, from CEOs to individual investors, willingly walk into this trap. The decision to take on debt or to invest in a company that uses it heavily is rarely born from a dispassionate analysis of risk. It is born from powerful, often unconscious cognitive biases. The two most prominent are the fear of missing out, or FOMO, and a profound overestimation of our own predictive abilities, a form of optimism bias. Consider a company in a rapidly growing industry. Its competitors are all expanding aggressively. They are building new factories, launching massive marketing campaigns, and acquiring smaller rivals. How are they funding this? In most cases, with debt. The CEO of our company sits in the boardroom. He sees his competitors grabbing market share. He reads headlines praising their bold vision. His shareholders are asking, why aren't we growing as fast as them? The pressure is immense. The fear of being left behind, of becoming irrelevant, is a palpable physical force. This is FOMO in the corporate world. Debt presents itself as the easy answer, the magic potion that will allow them to keep pace. It allows for growth now, paid for by the future. The potential reward, market leadership, a rising stock price, a bigger bonus, is vivid, immediate, and exciting. The potential risk, a future recession that could bankrupt the now indebted company, is abstract, distant, and feels unlikely. Investors fall for the exact same bias. They see a stock that is soaring, fueled by debt-financed growth. They hear the exciting story. They see their friends making money on it. The fear of missing out on those gains overwhelms the quiet, rational voice that might ask about the balance sheet. Our brains are wired to react more strongly to social proof and the thrill of the chase than to the boring, methodical process of risk management. We are herd animals, and when the herd is stampeding towards a cliff, the instinct is to run with them, not to stand back and consult a map. Compounding this is a fundamental overconfidence in our ability to see the future. The CEO who takes on massive debt truly believes that the company's sales will continue to rise. He believes the economy will remain stable, He believes interest rates won't skyrocket. He feels he is in control. The investor who buys a heavily leveraged company believes the same things. They have extrapolated the recent past into the indefinite future, forgetting the one iron law of finance. The future is always uncertain. History is littered with the corpses of companies that were perfectly solvent for a world that no longer exists. They took on debt based on a set of assumptions, and when those assumptions proved false, when the unforeseen black swan event occurred, they had no margin for safety, no buffer to absorb the shock. Debt is the financial equivalent of betting your life that the sun will rise tomorrow. It probably will. But if it doesn't, the consequences are absolute. So how do we as intelligent investors arm ourselves against this potent combination of institutional pressure and psychological bias? We need a simple, ruthlessly effective mental model, a tool that cuts through the narrative and the emotion and gives us a clear binary answer. This is the margin of safety litmus test. It's a quick calculation you can perform in under 60 seconds that will instantly tell you if a company is standing on solid ground or on a trapdoor. Here is the blueprint, step by step. First, you need to find two numbers from a company's financial statements. You can find these for free on websites like Yahoo Finance, Google Finance, or directly from a company's investor relations website, where they post their quarterly 10Q and annual 10K reports. The first number you need is total debt. On the balance sheet, you'll typically see short-term debt and long-term debt. Just add them together. This is the total amount of money the company owes to its lenders. The second number you need is the company's annual earning power. For this, you can use net income, which is found on the income statement. An even better, more conservative number is free cash flow, which you can find on the cash flow statement. Free cash flow represents the actual cash the business generates after all its expenses and necessary reinvestments are paid for. It's the money left over that could, in theory, be used to pay down debt. Now for the test itself. Simply divide the total debt by the annual net income or free cash flow. The number you get represents the number of years it would take for the company to pay off its entire debt using its current profits. This is your debt-to-earnings ratio. And here is the rule of thumb, the core of this defensive investing strategy. If that number is greater than 4, a bright red flag should go up. If it would take the company more than 4 years of its entire annual profit to eliminate its debt, it means the debt is a significant, heavy burden. The company has a very thin margin for safety. Think of what this means in practical terms. A company that earns $2 billion a year and has $8 billion in debt is in a precarious position. For the next 4 years, every single penny of profit is already spoken for by the bankers. There's no money left to invest in new opportunities, to weather a storm, to increase a dividend, or to buy back shares. The company is effectively working for its lenders, not its owners. Now imagine a company that also earns $2 billion a year but has only $1 billion in debt. It could extinguish its debt with just 6 months of profits. This company is a master of its own destiny. It has options, it has flexibility, it has a fortress-like resilience. By applying this simple litmus test, you immediately screen out the vast majority of financially fragile companies. You are no longer susceptible to the seductive story of growth because you are anchored to the mathematical reality of the balance sheet. This isn't about finding the next hot stock, it's about the far more important first step of capital preservation, avoiding the businesses that are statistically most likely to blow up and cause you to lose everything. This simple test stands in stark contrast to the approach taken by the overwhelming majority of market participants. The path of the 99% is paved with a dangerous and seductive idea, the growth at any cost mindset. Most people, when they first get into stock analysis, are drawn to the income statement. They look at revenue. Is revenue growing? If it's growing at 20, 30, or 50% a year, they get excited. They see a dynamic, world-conquering company. They see the stock price going up, and they assume the business must be healthy. They rarely, if ever, click over to the balance sheet to ask the most important question: how is this growth being financed? Consider the spectacular rise and fall of a company like WeWork. The story was intoxicating. A charismatic founder, a mission to revolutionize the nature of work, and revenue growth that was off the charts. The company was expanding at a breakneck pace, opening new locations in major cities around the world, seemingly every week. Investors, from small retail traders to massive sovereign wealth funds, poured billions of dollars into the company, mesmerized by the top-line growth. The income statement, if you squinted and ignored the massive losses, showed a revenue line going straight up. But the balance sheet told a completely different and terrifying story. WeWork's business model required immense upfront capital for long-term leases and renovations. To fund its explosive growth, it took on billions upon billions of dollars in debt and lease obligations, which are a form of debt. It was a classic growth-at-any-cost strategy. The company was a house of cards built on a foundation of IOUs. When the market sentiment shifted, when investors began to question the path to profitability, the whole thing came crashing down. The planned IPO was pulled, the valuation plummeted by over 90%, and the company was left fighting for survival. The investors who were seduced by the revenue growth and ignored the balance sheet suffered a near-total loss of capital. They made a classic mistake. They confused growth with health. A company can grow itself straight into bankruptcy if that growth is funded by an unsustainable amount of debt. The 99% chase these exciting growth stories because it feels good, it's dramatic, it's hopeful. The careful, methodical work of balance sheet analysis feels like boring accounting. But as Buffett has proven over a lifetime, successful investing is not meant to be exciting. It's meant to be profitable. The growth-at-any-cost mindset is a siren song that has lured countless portfolios onto the rocks of insolvency. The financial connection here is stark and brutally direct. The danger of debt materializes on a company's income statement through a single tyrannical line item, interest expense. Let's make this tangible. Imagine two companies, Fortress Corp and Gamble Inc. Both are in the same industry and are identical in every way except for their capital structure. Both generate $100 million in revenue and have operating expenses of $70 million, leaving them both with an operating profit, or EBIT, of $30 million. Fortress Corp was built conservatively. It has zero debt, so its operating profit of $30 million flows directly to its pre-tax profit line. After paying, say, $10 million in taxes, its net income is $20 million, a solid, profitable business. Gamble Inc., on the other hand, was built by a CEO with a growth-at-any-cost mindset. It has a large amount of debt on its balance sheet, and the annual interest expense on that debt is $15 million. So its income statement starts the same: $100 million in revenue, $30 million in operating profit. But then comes the tyranny of the interest expense. Before Gamble Inc. can even think about profits for its shareholders, it has to pay the bank $15 million. This cuts its pre-tax profit in half to just $15 million. After taxes of, say, $5 million, its net income is only $10 million, half that of its competitor, despite having the exact same business operations. But this is where the real danger begins. The economy hits a rough patch. A mild recession causes revenue for both companies to fall by 20%, from $100 million to $80 million. Their operating expenses also fall a bit, let's say to $65 million. For Fortress Corp, the new operating profit is $80 million minus $65 million, which is $15 million. A significant drop for sure, but after taxes of $5 million, it still has a net income of $10 million. It's less profitable, but it is still solidly in the black. It survives to fight another day. Now look at Gamble Inc. Its new operating profit is also $15 million, but its interest expense does not change. The bank doesn't care about a recession. That $15 million is still due. So, Gamble Inc.'s operating profit of $15 million is completely wiped out by its interest expense of $15 million. Its pre-tax profit is zero. It pays no taxes, but its net income is zero. Worse, if the recession were any deeper, its operating profit would be less than its interest expense, and the company would be losing money. Its shareholders would be wiped out. It would likely violate its debt covenants, allowing the bank to call in its loans and force the company into bankruptcy. This simple example reveals the terrifying mathematics of leverage. A 20% drop in revenue for the debt-free company resulted in a 50% drop in profits. For the debt-laden company, that same 20% drop in revenue resulted in a 100% drop in profits and pushed it to the edge of the abyss. Debt acts as a lever that magnifies outcomes. When times are good, it magnifies gains. But when times are even slightly bad, it magnifies losses to a catastrophic degree. This is the direct financial manifestation of risk. It's not a theory, it's an accounting certainty. This leads us to a more subtle and dangerous idea, a concept that is taught in every business school and championed in every boardroom, the idea of good debt. This is the Buffett paradox. The conventional wisdom states that debt, when used intelligently, is a powerful tool. It's called strategic leverage. The argument is that if a company can borrow money at 5% and invest it in a project that earns 15%, it would be foolish not to. This use of debt juices the returns for shareholders, specifically a metric called return on equity, and is seen as the mark of a sophisticated executive. To Buffett, this entire line of thinking is a dangerous illusion, a high-stakes gamble masquerading as a science. There is no more powerful illustration of this illusion than the spectacular collapse of long-term capital management, or LTCM, in 1998. If ever there was a group of people who should have been able to handle good debt, this was them. The firm was founded by John Meriwether, a legendary bond trader from Salomon Brothers, and its partners included Myron Scholes and Robert C. Merton, who had just won the Nobel Prize in Economics for their work on options pricing. These were not reckless gamblers. They were the high priests of financial theory. Their strategy was to use complex mathematical models to identify tiny pricing discrepancies in global bond markets, and then use enormous amounts of leverage to turn these tiny, near-certain profits into huge returns. They believed they had created a money machine. Their models, they claimed, showed that the risk of a major loss was infinitesimally small, a once-in-a-universe event. On the back of this intellectual certainty, they convinced the world's largest banks to lend them over $100 billion. With only about $4 billion of their own capital, they were leveraged more than 25 to 1. Every dollar of equity was controlling more than $25 in assets. This was strategic leverage on an epic scale. For a few years, it worked brilliantly. The Nobel laureates were hailed as geniuses, and their investors were richly rewarded. But in 1998, the unforeseen happened. Russia defaulted on its government bonds, and a subsequent flight to safety caused market correlations to behave in ways their models had never predicted. The tiny near-certain trades all went wrong at once. Because of the immense leverage, small losses were magnified into catastrophic firm-destroying black holes. In a matter of weeks, LTCM was on the verge of collapse, threatening to take the entire global financial system down with it as its creditor banks faced massive losses. The Federal Reserve had to orchestrate an emergency bailout, and ironically, Warren Buffett was called in as a potential investor to help salvage the wreckage. He offered to buy the firm's portfolio for a pittance, but the deal ultimately fell through. The lesson of LTCM is profound. Here you had the smartest people in the room, using what they believed was a risk-free strategy, and leverage still managed to blow them up. Why? Because their models were based on a world of bell curves and normal distributions, but the real world is a place of wild, unpredictable events. Buffett's takeaway was simple. If those guys could get wiped out by leverage, anyone can. He famously quipped, to make money they didn't have and didn't need, they risked what they did have and did need. That is foolish. This is the core of the Buffett paradox. The pursuit of slightly better returns by using debt introduces a small, but very real, risk of total and permanent ruin. For Buffett, that trade-off is never ever worth it. There is no such thing as good debt, because all debt, no matter how cheap or strategically deployed, carries with it the seed of your own destruction. This catastrophic failure of intellect was driven by a cognitive bias that is particularly pernicious among the successful and the intelligent, overconfidence bias, coupled with the illusion of control. The partners at LTCM weren't just confident, they were absolutely certain of their model's superiority. Their Nobel Prizes were not just awards, they were proof that they had transcended the normal risks of the market. They believed their intelligence insulated them from chance. This is the same bias that afflicts the modern CEO who champions strategic leverage. This CEO has a history of success. Every decision they've made has worked out. They've navigated the company through challenges and delivered growth. This success breeds an illusion of control. They start to believe that they can manage the unmanageable, that they can predict the unpredictable. They look at taking on $1 billion of debt not as introducing a fixed, unforgiving risk, but as just another variable that their superior management skills can handle. They think, we can handle the debt because our business is strong, our forecasting is accurate, and we are smarter than the competition. They forget that debt doesn't care how smart you are, it only cares if you can make the payment. This overconfidence is a deep-seated human trait. We are wired to believe we have more control over events than we actually do. It's why people believe they can influence a roll of the dice by throwing it harder or softer. It's why drivers almost universally rate themselves as above average. In the world of corporate finance, this bias is amplified by the echo chamber of the boardroom and the adulation of the financial press. The CEO who uses leverage to post a great quarterly return is hailed as a genius. The conservative CEO who avoids debt and posts a slightly lower but infinitely safer return is seen as a plotter. The system rewards the appearance of control and the short-term gains that leverage can produce, reinforcing the dangerous belief that risk has been tamed. Buffett's genius is in his humility. He starts with the assumption that the future is unknowable and that he cannot control it. This forces him to build a system that doesn't require prediction or control, a system built on resilience, not leverage. To counteract this powerful bias, we need a mental model that forces humility upon us. We need a framework that shifts our focus away from potential rewards and squarely onto potential risks. This is the invert always invert framework, a concept borrowed from Buffett's longtime partner, Charlie Munger. Munger famously said, "All I want to know is where I'm going to die, so I'll never go there." It's a morbid but brilliant piece of logic. Instead of asking how to achieve success, you ask what would guarantee failure, and then you avoid it at all costs. When applied to the decision of taking on debt, the inversion is transformative. The normal forward-thinking question is, how can we use this debt to increase our profits and boost our return on equity? This question is full of optimism and focuses on the upside. The inverted question is, what would have to happen for this debt to bankrupt us? This question forces a pre-mortem. It forces you to imagine a future where everything has gone wrong. Here is the blueprint for applying this framework. Step 1. List every single assumption that must hold true for the debt to be manageable. For example, our revenues must remain at or above their current level. Our main competitors must not start a price war. Interest rates must not rise significantly. Our key suppliers must remain solvent. Our industry must not be disrupted by a new technology. Step 2. For each of these assumptions, you must ask two brutal questions. First, what is the real, objective probability that this assumption could prove false over the life of the debt? Not what you hope, but what history suggests. Second, what are the full, unvarnished consequences if it does prove false? Step 3. Scrutinize your list of consequences. If the failure of any single one of your core assumptions leads to a scenario of existential risk, of bankruptcy, of a forced fire sale of assets, of a total wipeout of shareholder equity, then the debt is unacceptable. Period. It doesn't matter if the probability seems low. The fact that a single point of failure can lead to total ruin means you are playing Russian roulette with the entire enterprise. This inversion framework acts as a powerful antidote to overconfidence. It forces you to confront the fragility of your own predictions. You move from being a cheerleader for the upside to being a paranoid, detail-obsessed auditor of the downside. It's a way of thinking that is alien to the culture of bold vision and aggressive growth, but it is the absolute bedrock of long-term survival and sustainable wealth management. It is the core of defensive investing. The path of the 99%, of course, is the exact opposite. It is a path that has been paved and polished by decades of academic theory and business school curricula. It is what I call the MBA-ification of business, where debt is not viewed as a danger, but as a sophisticated tool for financial engineering. Students are taught complex models like the Modigliani-Miller theorem, which, in a perfect world of theory, suggests that a company's value is unaffected by its capital structure, and that there might even be a tax advantage to using debt. The most seductive and dangerous metric taught in this world is return on equity, or ROE. ROE is calculated as net income divided by shareholders' equity. It's supposed to measure how efficiently a company is using its owners' capital to generate profits. The higher the ROE, the better. But there is a mathematical backdoor to this metric. Because shareholders' equity is in the denominator, you can increase your ROE in two ways. You can increase your net income, or you can decrease your shareholders' equity. Taking on debt does the latter. When a company borrows money, its assets and liabilities both increase, but its equity base does not. In fact, if a company uses debt to buy back its own stock, it actively reduces its shareholders' equity. This creates a perverse incentive. A CEO can make their company appear more efficient and profitable on a per-share basis simply by loading it up with leverage. Imagine a company with $100 million in equity that earns $10 million in profit. Its ROE is a respectable 10%. The CEO, wanting to impress Wall Street, decides to borrow $100 million and buy back half the company's stock, reducing the equity to $50 million. Now, after paying interest on the debt, let's say the company's profit drops to $7 million. The new ROE is $7 million divided by $50 million, which is 14%. The ROE went up. The CEO looks like a genius. But is the business better? No, it is infinitesimally more fragile. It now has the non-negotiable requirement of servicing $100 million in debt. This financial engineering is an intellectual trap, and the 99% of investors who rely on simplistic metrics like ROE walk right into it, applauding companies for taking on the very risks that will eventually destroy them. To see through this financial sleight of hand, we need to upgrade our analytical toolkit. The direct financial connection here is understanding the critical difference between return on equity, ROE, and a far superior metric, return on invested capital, ROIC. While ROE tells you the return on the owner's slice of the pie, ROIC tells you the return generated by the entire pie, all the capital, both equity and debt, that the business employs. The calculation for ROIC is a bit more involved, but the concept is simple. It's the company's after-tax operating profit divided by its total invested capital, which is essentially shareholder equity plus total debt minus cash. Don't worry about the exact formula, just understand the principle. Because debt is included in the denominator, the invested capital part, a company cannot artificially inflate its ROIC simply by borrowing more money. ROIC measures true operational excellence. It answers the question, how good is this management team at taking $1 of capital from any source and turning it into profit? Let's go back to our CEO who used debt to boost his company's ROE from 10% to 14%. If we were to calculate the ROIC before the transaction, it might have been 10%. After taking on the debt, the numerator, operating profit, has gone down due to interest, and the denominator, invested capital, has gone up because of the new debt. The new ROIC will have actually decreased, perhaps to 7 or 8%. The ROIC calculation reveals the truth that the ROE calculation concealed. The business did not become more profitable. It became less profitable and more risky. A business that can consistently generate a high ROIC, say above 15%, without using much debt is the holy grail of value investing. It is a sign of a truly superior business with a durable competitive advantage. It is a company that creates wealth organically through the sheer quality of its operations, not through financial gimmickry. Learning to favor ROIC over ROE in your stock analysis is like having X-ray vision. You can see past the engineered facade of high ROE and identify the companies with truly strong financial skeletons. This is the foundation of genuine fundamental analysis. Now that we have established the dangers of debt and the illusions that promote its use, we can turn our attention to the positive side of the ledger. What does a financially strong company actually look like? How do we identify the companies that are not just avoiding ruin, but are actively built to survive and even thrive in times of chaos? We must learn to identify the fortress balance sheet. For the perfect illustration of the power of a fortress balance sheet, we look to one of Buffett's most important and beloved acquisitions, See's Candies, purchased in 1972. See's was and is a phenomenal business. It sells a high-quality, emotionally resonant product. But its secret weapon, the thing that made it such a powerful engine for Berkshire Hathaway, was its financial structure. See's required almost no capital to grow. It had no long-term debt. The business operated on what is called a negative cash conversion cycle. Customers paid for their candy up front, in cash. See's, in turn, paid its suppliers for sugar and chocolate on a 30 or 60-day basis. This meant the company was constantly holding a float of cash that belonged to its vendors, which it could use to run its operations. The company was a cash geyser. Every year, it produced millions of dollars in profit. In a normal, capital-intensive business, that profit would have to be reinvested into new machinery, new factories, or research and development just to stay competitive. In a leveraged business, a huge chunk of that profit would be sent to the bank to service debt. But at See's, the cash just piled up. The company didn't need it. So, every year, Mary C. and her team would send a check for millions of dollars in excess cash to Warren Buffett in Omaha. This anecdote is the inverse of the Wombeck Mills story. It isn't about avoiding a disaster, it's about harnessing a massive, ongoing opportunity. That cash from See's, which was a direct result of its debt-free, capital-light business model, became the seed corn for Berkshire's future. Buffett took the profits from chocolate and used them to buy stocks, acquire other businesses, and build the foundation of the empire we see today. The fortress balance sheet of See's Candies didn't just protect it from downturns, it made it a powerful engine for compounding wealth. It demonstrates that financial conservatism is not about timidly hiding from risk. It's about building a base of such unshakable strength that you have the freedom and the resources to seize opportunities when they appear. The culture that builds a fortress balance sheet is rooted in a psychological principle that is as old as humanity itself: delayed gratification. A company that shuns debt is making a conscious choice. It is choosing long-term resilience over the short-term sugar high of juiced returns. It is the corporate equivalent of the famous marshmallow test, where children who could resist eating one marshmallow now in exchange for 2 marshmallows later went on to have far more successful lives. That ability to delay gratification is a powerful predictor of success for both people and businesses. Debt is the ultimate tool of instant gratification. It allows a company to have the new factory now, the big acquisition now, the share buyback now, the price is paid later in the form of risk and fragility. A company that insists on funding its growth with its own internally generated cash is demonstrating incredible discipline. It is saying that it will only grow as fast as its actual success allows. This creates a powerful virtuous cycle. The discipline required to operate without debt forces a company to be incredibly efficient and focused on generating real cash profits. These profits then build up on the balance sheet, creating an even stronger fortress that allows the company to weather any storm and emerge stronger on the other side, while its leveraged competitors are weakened or destroyed. This patient, deliberate approach allows the miracle of compounding to work its magic, uninterrupted by the crises that periodically wipe out the impatient. So how do we systematically identify these financial fortresses? We need a more comprehensive tool than our initial litmus test. We need a financial fortress checklist. This is a multi-point inspection of the balance sheet that will give you a high-resolution picture of a company's financial health. Here are 4 key checks. First, the debt-to-equity ratio. This is a classic metric. You take the company's total debt and divide it by its shareholder equity. This tells you how much the company relies on lenders versus its owners for financing. A ratio of 1.0 means for every dollar of owner's capital, there is a dollar of debt. As a conservative rule, you want to see a debt-to-equity ratio below 0.5. Many of the best businesses in the world operate with a ratio close to 0. Second, the current ratio. This measures a company's ability to pay its short-term bills. You calculate it by dividing current assets by current liabilities. Current assets are things like cash, inventory, and accounts receivable that can be converted to cash within a year. Current liabilities are bills due within a year, like payments to suppliers and short-term debt. A current ratio below 1.0 is a massive red flag, as it means the company doesn't have enough liquid assets to cover its immediate obligations. You want to see a healthy current ratio, ideally above 1.5 or 2.0, which indicates a comfortable liquidity buffer. Third, the interest coverage ratio. This measures how easily a company can make its interest payments. You calculate it by taking the company's earnings before interest and taxes, EBIT, and dividing it by its annual interest expense. This number tells you how many times over the company's operating profit covers its interest payments. A company with an interest coverage ratio of 2 is earning just enough to pay its interest twice. That's a thin margin. You want to see a high number here, ideally above 5, and the higher the better. A company with a ratio of 20 is in no danger of defaulting on its debt. Fourth, and perhaps most importantly, look for a long-term history of positive free cash flow. Go to the cash flow statement and look back 5 or 10 years. Has the company consistently generated more cash than it consumes? A company that is a consistent cash generator doesn't need to borrow money from anyone. It finances its own existence. This track record is proof of a durable, healthy business model. By using this 4-point checklist, you move beyond a single rule of thumb and become a true financial statement analyst. You are inspecting the foundations, the plumbing, and the wiring of the business to ensure it is built to last. This is the core skill of portfolio protection. This disciplined approach is, once again, the polar opposite of the path followed by the 99% of investors. Most people are not drawn to the quiet, boring strength of a fortress balance sheet. They are drawn to drama, to story, and to the thrill of a potential comeback. This is the allure of chasing yield and complex turnarounds. They seek out companies that are in trouble, often heavily indebted, believing they can get in at the bottom and ride the stock to a 10x return if a miraculous turnaround occurs. Think of industries like the airlines. Historically, they have been a terrible business, characterized by brutal competition, high fixed costs, and mountains of debt used to finance their fleets. Yet, investors flock to them time and time again, betting that this time will be different. They buy the story of a new management team, a new route strategy, or a potential merger, ignoring the fact that the balance sheets are perpetually fragile and vulnerable to the slightest economic downturn or rise in fuel prices. They are, in effect, buying lottery tickets. They are mesmerized by the potential payout while systematically ignoring the overwhelming probability of losing. Buffett has famously said, if a capitalist had been present at Kitty Hawk back in the early 1900s, he should have shot Orville right. He would have saved his descendants a lot of money. He is not being anti-progress. He is making a sharp observation about the disastrous economics of capital-intensive, debt-reliant industries. The successful investor understands that the most reliable path to wealth is not through high-risk, high-reward bets on fragile companies, but through the steady, relentless compounding of capital in strong, resilient ones. It is less dramatic, but infinitely more effective. Avoiding the exciting turnaround stories and focusing on the boring companies with pristine balance sheets is a crucial step towards achieving real, lasting financial success. The direct financial manifestation of a fortress balance sheet, the ultimate proof of its power, is found in the section of the balance sheet called shareholder equity, and specifically within a line item called retained earnings. When a company makes a profit, it can do two things with it. It can pay it out to shareholders as a dividend, or it can reinvest it back into the business. This reinvested profit accumulates over time on the balance sheet as retained earnings. Think of what this number represents. It is the cumulative, undeclared dividend of the company's entire history. It is a tangible record of all the wealth the business has created and kept since its inception. A company with low debt and a massive, growing retained earnings account is a compounding machine made visible. It is a business that has been built brick by brick, year after year, not with borrowed money from a bank, but with its own success. This retained capital is then used to strengthen the business, develop new products, and fund prudent growth, which in turn generates more profit, which is then retained, and the virtuous cycle continues. When you look at the balance sheet of a Berkshire Hathaway or a Microsoft, you see this principle in action on a grand scale. The shareholder equity is immense, and the debt is minimal or non-existent in comparison. This equity is not some abstract accounting figure, it is a mountain of capital, a war chest that gives them incredible power and flexibility. This is the ultimate financial connection. A culture of debt avoidance directly translates into a balance sheet overflowing with retained earnings, which represents stored economic energy, ready to be deployed. This is what capital preservation and brilliant asset allocation look like in practice. But the decision to take on debt is not always made by well-intentioned, if overconfident, managers. Often, the pressure to lever up comes from powerful external forces with their own agendas. This is the siren song of leverage, sung by a Wall Street ecosystem designed to profit from the creation and trading of debt, often to the detriment of the companies themselves. To understand this dynamic, there is no better case study than the epic 1988 leveraged buyout, or LBO, of R.J.R. Nabisco, a story immortalized in the book and film Barbarians at the Gate. R.J.R. Nabisco was a massive, stable, cash-producing conglomerate that owned brands like Oreo cookies and Winston cigarettes. Its CEO, F. Ross Johnson, decided to take the company private, and this kicked off a massive bidding war involving the top private equity firms on Wall Street, most notably Kohlberg Kravis Roberts, or KKR. The mechanics of an LBO are deceptively simple. The private equity firm puts up a small amount of its own money and borrows an enormous amount of new debt, using the assets and cash flows of the target company itself as collateral. They then use this pile of borrowed money to buy all of the company's stock and take it private. In the case of R.J.R. Nabisco, the final price was an astounding $25 billion, almost all of it debt that was loaded directly onto R.J.R. Nabisco's own balance sheet. Overnight, a financially sound company was transformed into one of the most heavily indebted corporations in the world. Who benefited from this? The investment bankers and lawyers who advised on the deal collected hundreds of millions of dollars in fees. The private equity firm KKR stood to make a fortune if they could somehow manage the massive debt load and sell the company or its pieces for a profit a few years later. The original shareholders got a nice one-time payout. But the company itself, the underlying business of making cookies and cigarettes, was now crippled. It was forced to sell off assets and slash costs, not for strategic reasons, but simply to generate enough cash to make its crushing interest payments. The LBO didn't create any new value. It simply transferred wealth from the company to the dealmakers, using debt as the weapon of transfer. This story reveals a fundamental truth about Wall Street. The system is often structured to reward transactions and financial engineering, not the patient, long-term stewardship of a business. This entire ecosystem thrives on a powerful psychological principle: incentive-caused bias. Charlie Munger has said that this is one of the most powerful forces in the world. "Show me the incentive," he says, "and I will show you the outcome." The incentives surrounding the use of corporate debt are almost universally tilted in favor of taking on more of it. Investment bankers work on commission. They get paid enormous fees for arranging debt offerings and advising on debt-fueled mergers. They have zero incentive to advise a CEO to be fiscally prudent. A CEO who isn't doing deals or issuing bonds is a CEO who isn't generating fees. Private equity managers are compensated with a model called 2 and 20, a 2% management fee on assets, and 20% of the profits. Leverage is the key to making this model work. By using 90% debt to buy a company, they can amplify a small gain in the company's value into a massive return on their 10% equity slice. The risk is borne by the company and its lenders, but the reward is captured by the private equity manager. Even the incentives for the CEO can be skewed. Many CEOs have their bonuses tied to short-term metrics like earnings per share, EPS. A quick way to boost EPS is to use debt to buy back company stock. This reduces the number of shares outstanding, so the same amount of profit is divided by fewer shares, mathematically increasing the EPS. The company is now riskier, but the CEO gets a bigger bonus. The system is riddled with these conflicts of interest, where the short-term financial incentives of the agents, the bankers, the managers, the CEO, are not aligned with the long-term health of the principal, which is the business itself. To protect ourselves as investors from being on the losing side of these transactions, we need a mental model to diagnose these misaligned incentives. This is the principal-agent problem detector. The core idea is to analyze every major corporate action not just from a business perspective, but from the perspective of who benefits. Here is the blueprint for its application. When a company announces a large, debt-fueled acquisition or a massive share buyback program, you must become a cynic and ask a series of pointed questions. 1. Who gets paid a fee immediately? The investment banks, law firms, and consulting firms involved will make a fortune regardless of whether the deal is a success or a failure. This is an immediate red flag. 2. How is the CEO's compensation package structured? Go to the company's proxy statement and read the compensation discussion. Is the CEO's bonus tied to revenue growth or earnings per share, metrics that can be easily manipulated with a debt-fueled acquisition? Or is it tied to long-term, more honest metrics like return on invested capital? 3. What is the time frame of the reward versus the risk? The potential reward of the deal, a rising stock price, a bigger bonus, is often front-loaded into the next 1 to 2 years. The potential risk, the possibility of the debt crippling the company in the next recession, is a long-term problem that may not manifest for 5 or 10 years. Long after the current CEO has retired with a golden parachute. 4. And most critically, is management a true owner? You need to investigate the level of insider ownership. Does the CEO and the management team own a significant amount of stock that they purchased with their own money or have held for many years? If so, they are more likely to think like a principal, like an owner. Their personal wealth is tied to the long-term health of the business, and they will be naturally averse to existential risks. If, however, their ownership consists mainly of stock options that they can cash in after a short-term rise in the stock price, they are acting as agents, and their incentives may be dangerously misaligned with yours as a long-term shareholder. This framework helps you pierce the corporate veil and understand the true motivations behind the decisions that create risk. The 99% of investors are easily fooled by these motivated decisions because they fall for the accompanying narrative. When a company takes on billions in debt to merge with a rival, the press release is always filled with glowing terms like synergies, strategic fit, and transformational. The story sounds compelling, and most people buy it hook, line, and sinker without ever questioning the underlying incentives or the astronomical price paid. The history of business is a graveyard of these synergistic dreams. The most infamous example is the disastrous merger of AOL and Time Warner in 2000. It was billed as the perfect marriage of new media and old media. AOL, the high-flying internet company, used its inflated stock to acquire the venerable media empire of Time Warner. The deal was financed with complex arrangements and was predicated on the idea that massive synergies would be unleashed. The reality was a catastrophic culture clash and a business model that made no sense. The promised synergies never materialized, and as the dot-com bubble burst, the company was forced to take a nearly $100 billion write-down, one of the largest corporate losses in history. Investors who believed the synergies narrative and ignored the absurd valuation and the clash of business models lost a fortune. They learned a hard lesson. A compelling story is not a substitute for sound business logic and a conservative financial structure. The vast majority of large, debt-fueled mergers fail to create shareholder value. They are often a sign of a management team that has run out of good ideas for organic growth and is resorting to empire building, an activity that benefits the egos of executives far more than the wallets of shareholders. The physical scar left on the balance sheet by these failed, debt-fueled acquisitions is often an asset called goodwill. When a company buys another company for a price that is higher than the fair market value of its tangible assets, like its factories and cash, the difference is recorded on the acquirer's balance sheet as goodwill. It is, in essence, an intangible asset, representing things like brand reputation or customer relationships. A balance sheet that is bloated with a massive amount of goodwill is a major red flag. It is a historical record of the company's past acquisitions. If a company has a lot of goodwill and also a lot of debt, it tells you a story. This company has a history of paying high prices for other companies and using borrowed money to do it. This is often a sign of a reckless, empire-building management team. The danger of goodwill is that it is not a real, physical asset. If the acquired business underperforms and is not worth what the company paid for it, accounting rules force the company to take a, quote, goodwill impairment. This is a massive write-down where the company admits it overpaid and a huge chunk of that goodwill asset is wiped off the balance sheet, directly reducing shareholder equity. These write-downs can be enormous and are a public admission that the acquisition and the debt used to finance it was a terrible mistake that permanently destroyed shareholder capital. A balance sheet with a high ratio of goodwill to assets is a museum of past expensive mistakes, and it's a clear warning to any prospective investor. This brings us to our final and most nuanced pillar. So far, we have focused on numbers and models, but Buffett has always maintained that he is investing in businesses which are run by people. The ultimate protection against the dangers of leverage is not just a strong balance sheet, but a management team whose character and philosophy are fundamentally debt-averse. The numbers on the balance sheet are merely a reflection of the decisions made by the people in the executive suite. For Buffett, the gold standard of management was exemplified by Tom Murphy and Dan Burke, the duo who ran Capital Cities/ABC. Buffett admired them so much that he once said if his wife Susie and his son Howard were in a lifeboat with Murphy and he could only save one, he'd tell them to save Murphy. It was his way of saying that Murphy's managerial talent was a national treasure. Capital Cities was legendary for its fanatical focus on operational efficiency and financial conservatism. They ran their television and radio stations with skeleton crews, abhorred corporate waste, and almost never used debt. Their focus was on maximizing the cash flow of the businesses they owned. In 1985, Capital Cities, a relatively small company, did the unthinkable. They announced they were acquiring the much larger ABC network. It was a minnow swallowing a whale. To finance the deal, they needed a partner, and they turned to Buffett and Berkshire Hathaway. Buffett eagerly invested not just because he liked the economics of the media business, but because he was betting on the character of Murphy and Burke. He knew they were owner-operators at heart. He knew they would run the combined company not with Wall Street's playbook of financial engineering, but with their own time-tested philosophy of decentralization, cost control, and fiscal prudence. And that is exactly what they did. They transformed the bloated ABC bureaucracy, paid down the acquisition debt with incredible speed, and turned the company into a cash-generating machine. The story of Capital Cities/ABC is the ultimate proof that a company's financial strength is a direct outgrowth of its management's character. This highlights the crucial psychological difference between an ownership mindset and a managerial mindset. A manager with an ownership mindset, like Tom Murphy, thinks about the company's money as if it were their own, scraped together over a lifetime of work. They feel a deep, personal pain at the thought of waste. They view debt not as a tool, but as a dangerous claim on their life's work by an outsider. They have a long time horizon. They are building an institution that they want to last for generations. Their primary goal is not to meet the next quarterly earnings estimate, but to ensure the enterprise survives and thrives for the next 50 years. A manager with a purely managerial mindset, on the other hand, sees the company's money as an abstract resource. They are a hired gun, an agent brought in to perform a task. Their time horizon is often limited to the 3 to 5 year term of their contract. Their incentives are tied to short-term stock performance and hitting specific metrics. They are more willing to roll the dice with leverage, because if the bet pays off, they get a massive bonus. If it fails and the company goes bankrupt, they can often walk away with their reputation and fortune intact, leaving shareholders to hold the bag. Buffett's entire strategy is to find businesses that are run by people with the ownership mindset. These are the people you can trust to be prudent stewards of your capital, because they are treating it as if it were their own. How can we, as outside investors, assess this qualitative, human element? The best tool we have is the annual letter character analysis. The CEO's annual letter to shareholders, found at the beginning of every annual report, is the single best window into the mind of management. Most investors skip this section, treating it as corporate fluff. This is a huge mistake. By reading the last 5 or 10 years of these letters, you can perform a deep character analysis. Here is the blueprint for what to look for. First, analyze the language. Does the CEO talk about debt as a strategic tool or a source of risk? Do they focus on GAAP earnings, which can be easily manipulated, or do they talk about free cash flow, the true lifeblood of a business? Is the letter filled with jargon and buzzwords, or is it written in plain English, as if they were explaining the business to a partner? Second, look for candor. Does the CEO openly and honestly discuss the mistakes that were made during the year? Do they take personal responsibility? Or is every single year presented as an unqualified success and a string of brilliant decisions? A manager who cannot admit to small mistakes is a manager you cannot trust when a big mistake happens. Third, what is their focus? Is the letter all about grand visions and industry-changing disruptions, or is it focused on the nitty-gritty blocking and tackling of running the business well, things like cost control, product quality, and customer service? Finally, and most importantly, how do they discuss capital allocation? This is the CEO's most important job. Do they have a clear, rational, and consistent framework for how they will use the company's cash? Do they explain their decisions on reinvesting in the business, making acquisitions, paying dividends, and buying back stock? A great CEO will educate their shareholders on their capital allocation philosophy. A weak CEO will be vague or will simply follow the latest Wall Street fad. Reading a decade's worth of these letters will give you a better sense of a management team's character than any financial ratio ever could. It is the core of the intelligent investor approach pioneered by Buffett's mentor, Benjamin Graham. This careful qualitative analysis is the antidote to the final mistake made by the 99% of investors, falling for the cult of the visionary CEO. We live in an age that lionizes charismatic leaders who make bold promises and appear on the covers of magazines. Investors fall in love with the story, with the personality, and they stop asking hard questions about the underlying financials. They assume that a brilliant, visionary leader must also be a prudent financial manager. Often, the opposite is true. Many of these celebrated visionaries are funding their grand ambitions with mountains of other people's money. They are great at selling a dream, but they are often terrible at the boring, detail-oriented work of building a resilient enterprise. They take on huge amounts of debt to fuel their world-conquering plans, and their adoring investors applaud them for it. When the vision collides with economic reality, the entire edifice comes crashing down, because it was built on a foundation of charisma and leverage, not on a foundation of retained earnings and fiscal discipline. The lesson is clear. You must invest in the substance of the business, not the style of its leader. The ultimate direct financial connection, the final proof of a debt-averse management with an ownership mindset, is the ability to pay a sustainable, growing dividend. A dividend is a portion of a company's profit that is returned to its owners, the shareholders. A company that can consistently raise its dividend, year after year, decade after decade, the so-called dividend aristocrats, is providing irrefutable proof of its financial strength. Think about what it takes to do this. A company cannot fake a dividend. It requires real cash. To pay a growing dividend for decades, through multiple recessions and market cycles, a company must have a durable business model that generates prodigious amounts of free cash flow. It must have a fortress balance sheet with little or no debt so that cash isn't being siphoned off to pay lenders. And it must have a management team with incredible discipline and a long-term perspective, a team that is committed to returning capital to its owners. A sustainable, growing dividend is the direct financial consequence of a culture of debt aversion and operational excellence. It is the final, tangible reward for building a business on a foundation of rock, not sand. And for shareholders, it is a powerful and reliable path toward true financial freedom. You have just spent your valuable time absorbing a framework that forms the very bedrock of Warren Buffett's entire investment philosophy. You've gone beyond the simple advice of avoid debt and have acquired a powerful mental toolkit to understand why it's so critical. You now possess a, quote, financial shield, a simple, potent screening tool to eliminate the vast majority of dangerous stocks from your consideration, protecting your hard-earned capital from the single greatest cause of catastrophic loss. This is not a small thing. The discipline of capital preservation is the foundation upon which all great fortunes are built. You have mastered the art of defense. But Buffett's system is a network of interconnected mental models. Defense is only half of the game. Avoiding the companies that are destined for failure is the first step, but it doesn't tell you which companies are destined for greatness. The principles of avoiding ruin are different from the principles of achieving extraordinary growth. What we have built today is the shield, but a complete warrior needs a spear as well. The art of saying no to the fragile is essential, but the real magic comes from knowing how and when to say a confident and convicted yes to the truly exceptional. The video that YouTube is now recommending for you on your screen is the other side of that coin. It is the next piece of the map. If what we've just discussed is the shield that protects you from fatal blows, that video is the spear designed to find the heart of the market's greatest opportunities. It is the missing link that connects the principle of not losing money to the far more exhilarating principle of compounding money at extraordinary rates. You've proven you're serious about this journey by investing your time to master a core principle of defensive investing. The average person stops right here, content with simply being safe. But you are not the average person. The true intelligent investor, the person on the path to genuine financial freedom, understands that you must master both defense and offense. The choice to click is not about watching another video. It is about deciding to complete your mental arsenal. It is the next step on your path from being just an investor to becoming a true capital allocator. Continue your ascent.